Hi guys, welcome back. It's LSP. It's currently the 12th of June 2019. The time is 12:55 p.m. GMT time. I'm gonna wait for 5 minutes for the next hourly bar, and in the process, I'm gonna go through some things to kind of give you guys an idea of how I personally look at price, to kind of gauge from a study point of view. I'll start the video by saying this. Obviously, I've been in this trade since yesterday. Okay, a lot of the things that I post online have absolutely nothing to do with the way that I trade. Okay, what I mean by that is the risk management side of things and the targets and the stops and so on. Okay, I really have to emphasize my main account trading is very simple. Okay, this would have been done for me. This trade that I took yesterday would have been the week for me. I would have taken my 20 pips. So I would have opened a position either depending on the way it would have formed and where the stop would have been. I would have opened the position with either one standard or two standard lots. And if it was one standard, I would have taken 0.5 off at 20 pips and moved the stop to break even, and let the remaining 0.50 either go to 30 pips or go to to stop out. Or if it was two standard lots, one of those would have been off at 20 pips, break even, and then the remaining one lot or one standard would have gone to 30 pips, and that would have been it. Would have been done for the week. Had I not have taken this trade, this one would have been the one that I took instead. And again, from entry, 20 pips is here, and 30 pips is there, give or take, right? So again, I would have been out of the trade, but because I'm in the process of promoting myself, promoting the way that I trade, and promoting the ideas of how I approach the marketplace. I want to stay in these trades, open trades with bigger targets and wider stops sometimes to kind of illustrate certain points, or sometimes I'll be talking through trades like I'm doing now, all with the idea of kind of helping anybody who's watching the video. So I'll just pop over to the hourly chart for a second. Okay, you can see there's a lot of stuff that goes through traders' minds when they are in a trade, and this is why I've always promoted the idea of having a very, very small account and putting some skin in the game. Now, before I carry on, obviously I'm not licensed to give trade advice. I've said this before and I will repeat it again. I'm not licensed to give trade advice. That's never what this has ever been about. Okay, and I don't ever want anybody to get themselves into trouble, opening trades that they think I'm in, or something that I post online, or anybody else for that matter. You should always do your own analysis, and work through your own studies and arrive at ideas, by yourself. But it's always good to have somebody there who can consistently show, the same thing over and over and over again, and to learn from that person. And obviously in this case, I hope people are learning from myself. So you can see that price came within a few pips of my target. Okay, it was a couple of pips, like 1.9 pips or whatever it was. And this can be very frustrating for traders. Me, over the years, I arrived at that 20-30 pip rule. 20 stop, break even, 30 pip, either target or stop out on the last half. I arrived at that solution through years of getting aggravated and annoyed and frustrated over things like this happening to me over and over and over and over again. Okay, I've always had a very good read on price. Even if you look at some of the videos that I'm going to be posting, the old videos back in the 2000s when I was trading stocks, you'll see my read on prices has always been very, very good. Yeah, I've always had a very high level of understanding where price should go. Back then with stocks, I used to tape read as well, and I had other tools that I used to use to arrive at certain things. Whereas with Forex, it's slightly different. We used a different set of tools to arrive at the things that we arrive at. But like I said, I've always had a very good read on price, and I've always, in almost all cases, I know some of the old videos that you see are moving averages. You see the moving averages on the charts. Most of that really was due to the fact that I was moderating a trading room back then, and they used to use sort of moving averages. So I would have them on the charts, but I've got so many videos, one of which I'm going to be posting very soon, of naked price action, just to kind of give you guys some ideas of what I used to do back then and the kind of transition into sort of Forex. But with that in mind, having that understanding of being able to look at a chart and say, okay, look, I've got a very good idea that price is going to this particular level, is one thing. But then being able to capitalize on that and use that, to put yourself in a trade that makes money consistently, or in trades that makes money consistently, or that make money consistently, is not always easy. Anybody can pick a direction, and generally be right most of the time. You'll find a lot of beginning traders are generally right most of the time because instinctively, the cumulative knowledge over the years of them seeing certain things and then putting all of that into a cognitive decision to open a trade based on something that they see, they're generally right most of the time. The problem with beginning traders is stuff like this aggravates you, frustrates you, price getting very close. Then you start to see this pullback and you think, oh man, why didn't I just do this, or why didn't I just do that, so on and so on and so on. And it can stop you from actually learning from the actual trade. Okay, so if we break down this trade and see what's actually happening with this trade right now, you'll notice that my entries and my exits are very, very accurate. Okay, again, it's about context and about seeing the way price is moving based on certain characteristics, but more importantly, based on order flow from the higher time frame transposed all the way down to the lower time frames. Okay, that's effectively what I do. I look at price, in a certain way that allows me to see, that's already happened. So by rights, there's absolutely no reason that they would continue in that direction. It has to go the other way. That's how I see price. I try to put myself in situations where I know, A has been fulfilled, which means B has to be fulfilled now. Okay, 99% of the time, and that's where I kind of want to be, the sweet spot. So when we look at a trade like this, we say to ourselves, okay, look, what can I learn from this open trade? This is something that I'm in, I'm experiencing it, I'm feeling the movement, I'm seeing the process, okay, and I'm watching price moving up and down, and I'm monitoring the emotions that I'm going through, so I know kind of where I'm at, on a psychological level as well. I mean, am I level-headed? Am I frustrated now because I missed an opportunity to get out at, say, 40 pips, or just above 40 pips, or am I quite happy to just leave the trade? Am I of sound mind? Do I really want to just get out the trade now because I've had enough? And so on and so on and so on. So I'm monitoring my emotions, I'm monitoring my mental state. But from a price action point of view, okay, I made the choice based on what I was seeing on the day to move my stop to break even. Okay, so once my stop's been moved to break even, that's pretty much it. I don't need to move my stop. If I get stopped out, fine. I'm plus 1 pip, great. Preserve my capital plus add some pennies to my account, for example, right? So from a risk standpoint, I'm sitting happy, yeah. But let's sort of delve into the lower time frames and kind of see, all the whys of this trade. Okay, so again, we ran up here, had a pretty aggressive drop after that. Okay, so if we zoom in, I like to look at each individual candle and trying to get a really good feel for what's actually happening with price, and what's the process? What are they doing? Why did price do that? Yeah, so we've had a really nice run from the open, so to speak. So we get the open today. It comes down a little bit, and then we've had a really nice run. Going through the London session into sort of early New York. All right. So why did price stop here? Yeah, we know that there's liquidity above here. It's not a maybe. Like, we know there's liquidity above here. There has to be, right? So with that in mind, why did price stop here? Yeah. You can see it's a pretty aggressive drop. It's not like based on, and when I say aggressive drop, I'm not talking about some insane move. What I'm really saying is, based on the progressive move today, short, small, controlled price action, then we get this nice push, little bit of relief, really nice push, and then an aggressive drop based on everything that's happened today. I mean, this is quite pronounced. Okay, so why there? Is it enough for price to have just come up, to this point? I don't know. But if we look at some other things, it will give us a better indication as to whether or not this is real, so to speak, and is indeed going to change the direction of the trade. Okay. Now, from a risk management point of view, some of the things that I'm going to show you may put my risk slightly out, meaning that my stop may be too close now. Yeah, you know, price may very well come all the way back down here, stop me out, and then continue higher and take out the stops up here. I've seen cable do that plenty of times. You know, just have a drink. Sorry, guys. You know, I've seen cable do that many, many times. Okay, so let's see if this is real or not. You know, and again, we can't always be 100%, but let's see if this makes sense. Is this the turning point in the market? Is this the turning point in cable? And is it enough, you know, to invalidate the trade? And should I really be getting out right now? Okay. So when we drop down to the lower time frames, like before I continue, let's just be absolutely clear, right? It didn't take out this high. All right. So we'll make that really clear. Okay. So it's not taking out the high, so to speak. And we just look at the highs of the open and the close here. So the close of this candle and the open of this candle. It doesn't matter which one that we pick. The close, you know, we came very close to it. Okay, so from a liquidity standpoint, if you're going to be absolutely anal and accurate with the pips, you know, in terms of where the open and the close is of certain bars and the highs and the wicks and so on and so on and so on, okay, neither of those two objectives were fulfilled. Okay, this one wasn't and this one wasn't, based on my price action, based on my pricing, you know, on the broker that I use. Okay, some people might have seen a spike, but I just use what I see in front of me. Okay, so none of those two price objectives were fulfilled. Yeah. So if we drop down to, say, the 15-minute chart, we'll take a little bit of a look here. Okay, or looky-see, as they say. Again, nice and controlled price action, a little bit of a pop-up here, and then a nice aggressive drop. Okay, but where's it dropping to? Yeah, like where's it going? You know, why did it stop here? Okay, is it random? Maybe. You know, but I don't believe it is. I have plenty of evidence to show me, you know, over the years that things like this simply aren't random. Neither is this. You know, no price action is random. I don't believe that, and I have proven to myself conclusively that price action simply is not random. Okay, so why did price stop here? Well, if we take a look at the Asian range, okay, for me, I don't use the Asian range the way many other people are taught to use the Asian range, or there's, you know, one rule fits all. I only use the Asian range for one thing. Price is either above the Asian range or below the Asian range. It's a very simplified analogy, it's a very simplified explanation of the way that I use the Asian range, but that's pretty much it. Either above or below, okay? So we went above the Asian range here. Price has come all the way back down, and it's hit the Asian range, or gone back into the Asian range slightly, and we've had a nice, you know, nice reaction. Some price sensitivity here, some nice reaction from there, and then, you know, as you can see, you know, price is continuing to go higher. But don't forget, price was down here at one point, okay, about 9 pips away from the low of the Asian range, and about sort of 13 to 14 pips away from my stop. Okay, so this hadn't happened yet while price is coming down here. So it's very easy to look at that and think, oh, you know, am I going to get stopped out here? Should I just take my 10, 15, 20 pips or whatever I'm getting down here? Let me just see exactly what that was. Sorry. You know, should I take my 15 pips? Yeah. So again, it's very easy in the moment to lose sight of the trade that you're taking. Going back to what I was saying right at the beginning, I would have been out of this trade anyway, and all of this would have been a null issue for me. It wouldn't have made any difference, because I've managed over the years to find a way to protect myself from having to go through this, because it's very, very frustrating. But sometimes you have to go through this to experience the process of emotions, the biases that come out, the frustrations, and so on, for you to then look at a trade objectively and say, well, how could I have improved on this trade from a risk management point of view, from a price action point of view, from a technical analysis point of view, where there's some other factors that I'm not taking into consideration, maybe a fundamental driver or something, yeah? But you can't do all of that if you're kind of sitting on the sidelines and not really feeling all of this. You just see it, and you say, well, it did this and this, but eventually went back up there. That's all you see. You're not actually feeling the emotion of saying, oh man, I had 45 pips up here and now I've only got 15 pips. You have to experience that for you to learn from that, you know, and then progress as a trader. So going back up to, you know, the hourly. So you see price came down, it hit the Asian range, okay? I know the reasons why price hit this Asian range. It's, you know, again, when I do the trading room, guys, you know, or should I say, when I open up the trading room to everybody, okay, I'm hoping that it's going to be in a way where I can portray and show the ideas that I have in a way where it's going to be more manageable for people. Because right now you see sporadic videos that I post on YouTube, and I kind of go back and forth with a lot of different ideas because I've got so much going on in my head that sometimes I'll say one thing and then in a later video I forget that I've said that, you know, and then I don't produce the video in between, so it leaves a lot of confusion for people. And what I'm trying to do is I'm trying to get to a point where I can just have everybody in a room and just go through this in a nice scheduled way, yeah? But I can't sit here now and explain why I know or believe price came down here, hit the Asian range, and the reasoning behind that. Not just that it came down here and hit the Asian range, the actual reasoning behind that, the context behind it, the order flow behind it, the reason why it would have come down there, and why it makes sense that price isn't going to come down here and stop me out, you know, and maybe continue going higher at the time, yeah, while price was here, not now, at the time when price was here. So if we go back up to the hourly, okay, and we take the Asian range off so it's not cluttering up the chart, we can see again, price comes down here, okay, and what I'll do, what might be a little bit easier to do, is I'll drag this out and I'll see where price actually stopped. So you can see, you know, very close to the open, came down within these 3 down candles. Kind of makes sense, right? Within these 3 down candles, it makes sense that price would come down here, maybe accumulate some more of their position, okay, and then continue going higher to then take out the stops. There's also another bunch of reasons you can look at. Price came up here to make people think what I have just gone through, the frustration, the this, the that, get a lot of people out of the trade. They don't want people following along, you know, and making money behind their coattails, so to speak, and holding on, you know. They don't want that. I want to get you out of the trade as quickly as possible. Take up, you know, all of your liquidity, and then capitalize on that themselves and offload at a, you know, a much higher price. In this case, because it's going higher. Okay, so, you know, that's another reason. Okay, to get people fearful, to get people jumping in and out of trades that they really should just leave alone. You know, but then when we look at the weekly, and I have to show you the weekly because it makes more sense. At the time, this candle right here at the time looked like, I think the easiest way to just do this, guys, actually, sorry, I'll do this. Sorry, I'll take this off. This because I want to kind of emphasize what the candle actually looked like at the time. So we kind of have this this body, which was like this, similar to a doji. I'm sure you guys know what a doji is, or a doji, or whatever. You know, it kind of looked like this, right? Okay, maybe. That is actually quite incredible that it won't let me put it. Give me 1 second, guys. It's actually not letting me put it in the bar itself. Okay, we'll just have to do it like this. It's fine. Pretty much like that. Okay, so this is how the bar looked at the time when price was coming down to this level down here. Okay, without this. So it's very easy to look at this and think, sorry, I said that wrong. It's very easy to look at the lower time frames and think, oh man, I should have got out. You know, why didn't I just do this and why didn't I just do that? And then, you know, end up getting out of a trade that you should have just left alone, and so on and so on and so on. But then when you go up to the weekly chart and you actually look at what's happening, you can see that price opened, it came all the way down, all the way back up, and then we had this, you know, these you know, moves all the way, like these moves lower and then that nice push higher. It's rejection. Okay, now rejection comes in many forms. You know, it's a turning point, it's rejection, it's a reversal. You know, whatever label you use to, you know, to describe this to yourselves, the idea behind it's the same. Okay, price was down and now it's kind of reversed the entire movement and it's continuing to go higher. Okay, so stuff like this doesn't just happen for no reason, yeah, at all, and it shows that there's power behind the move that's happening. You know, because if it was weaker, or if it was still weak, it would have gone down. The bar still would be black, or the bar would have been black. You know, and maybe we finish sort of like down here and then continue to go lower and take out, you know, the liquidity down here, for example. But that's simply not the case. You know, we've come down here this week and now we're grinding all the way higher and we're hovering around an area that makes the most sense. You know, based on leaving this huge tail behind, or wick. Okay, so You look at this and you say to yourself, all right, look, I know price is getting a little bit funky on the 15-minute and possibly even the hourly, but is it really changing the overall context of, you know, the bias or the pull on price? Not really. Yeah, not really. So sometimes we have to jump up to the higher time frames and kind of remind ourselves that a lot of the stuff that happens on the lower time frames is just simply noise, you know. And to pull ourselves away from that noise, we jump back up to the, you know, to the higher time frames, daily, weekly, sometimes even monthly, and just say, all right, look, let's just take a step back. What's actually happening? Well, not a great deal. The issue with doing this is I'll explain a potential pitfall that can sometimes happen with the weekly and the hourly charts, or the weekly and the 15-minute chart. Okay, in terms of the weekly not really changing and still showing that the higher time frame drawn price is higher, but then the lower time frames giving you an idea that we could potentially, you know, be going lower and getting stopped out. The in-between part, this is where it can be a little bit tricky. I have a stop, okay, on my trade that is based on the hourly chart. I open the trade based on, you know, the hourly chart. From experience, I know roughly what the average true range is, or the average daily range is for cable, the average weekly range is for cable, and so on and so on and so on. So it's very, very simple and easy for me to open a trade based on, you know, these numbers. Okay, but then, like I said, when you go up to the weekly chart, you say to yourself, well, okay, while price, and I know I'm jumping around, I'm trying to keep up, I'm sorry, like, if I'm confusing anybody, but while price had come all the way down here, stopped at this level, I'm not talking about this, just ignore this, while price was sitting down here, okay, it's very easy for price to move another, at the time would have been roughly about here, you know, 15 or so pips, which we kind of worked out, roughly around about 15 to 20 pips, to stop me out and absolutely not change the overall context of the weekly range based on this weekly candle, you know. So when you're dealing with higher time frame pulls on price, you have to take into consideration that you're not trading a higher time frame range, okay? You're trading within a higher time frame range. You're saying, okay, I believe price is going to go to this point, and I'm using the weekly chart to, you know, to kind of give me that confirmation and that strong bias because it's a higher time frame. But I'm opening the trade based on an hourly or a 15-minute or possibly a 4-hour stop entry. All right, so you get to the entry a 4-hour or an hourly or a 15-minute stop. Sorry, that's what I meant to say. So you've got to learn to understand the differences between those two. If you're trading the weekly chart and you're looking for a weekly range, then you're expecting price to at least come up all the way up to here. Yeah. So in that case, you may, you know, have a stop from entry right now, for example, down here at 187 or so. Let's just call it a 200 pip stop. You know, and a potential. Well, that's not. You see, that doesn't even make any sense. So let's say here then. 100 pip stop for a potential 130 or so pip move, just as an example, because you're using the weekly chart for your entry, for your stops, and so on and so on and so on. So, you know, higher time frame analysis, lower time frame analysis, and kind of fusing the two together. You've got to remember to be able to separate what one is doing from what another is doing based on your own personal trading model. Okay. So let's just jump back over to the hourly chart and just kind of get a feel for, you know, what we're seeing. You can see, just based on price action the way it is, you know, I'm not expecting, you know, price to come all the way down here and stop me out. At the time here, I still wasn't, you know, it wouldn't have made a difference to me if it did, obviously, because it's just a trade. But I wasn't expecting price to come down there and stop me out for all the reasons that I've just discussed. But obviously for me, you know, having traded for such a long time, I find it very easy, you know, to kind of look at a chart and just assess this stuff very, very quickly. I'm not special, obviously. It's experience, it's time. You know, you see these things, you know, over time, and you just learn to just, you know, you see them very, very quickly and just kind of put your mind at rest and just let the trade do its thing. So with all that said, guys, I just wanted to kind of throw it out there. I will be leaving the trade, obviously, see what happens with it. You know, and hopefully we get the target today. It'd be quite nice, 50 pips. If not, then great, whatever. But either way, trade's going to be open, and I'll throw the results up on Twitter, you know, when I get a chance, or when the trade finally gets either stopped out or hits the target. All right, guys. So hope the video finds you well. I hope you learned something as always, and I will catch up with you guys in the I'll catch up with you guys in the next video. Take care.